Excellent. So very good. Camera is good. Very good. So we are here today with Albert and Alexei to talk about the future of capital markets. And both have intimate exposure in various roles, so they can just say a few words about themselves. And then we will jump in with a problem description, an opening statement by Albert, and then we will start expanding on that. Of course, we will touch upon market structures, how we protect participants, and what will happen when AI agents will run the entire show in a few years from now. So why don't we get started?
So I'm happy to be on this panel. My name is Albert Menkveld. I'm professor of finance at Vrije Universiteit, Amsterdam. And we'll talk about the future of capital markets. As an academic, I think it's fair to say that I have almost 3 decades of experience studying trade outcomes in exchanges, but also CCPs, central clearing parties. And I've been acting also in advisory roles at the French securities markets regulator, that is the Autorité Marché Financière, Capital Markets Committee now in the Dutch regulator, and I've been on visiting positions also at the Bank of England and the Bank of Canada, and I have a few things to say about what I want my capital markets to be in an age where technology is increasingly taking over.
Alexei, a few words about yourself.
Yeah, my name is Alexei Jiltsov. I am a co-founder of Tradefeedr. We're a technology company. You can see our brochure outside. What we do, we basically work with the data as an intermediary between banks and big hedge funds, and we're already applying some of the AI techniques to the data fields, and I hope I'm qualified to give some insights on the topic.
Great, thank you. My name is Ralf Kubli. I'm moderating the panel. So I'm on the board of 2 companies that one is building infrastructure in the DLT space, the other one is building infrastructure in traditional finance. So Albert, in preparation of the panel, what are some of the big problems that keep you awake at night?
So luckily I still sleep well at night. So, but I do have some concerns about the way we are going, and the key words for me are complexity and transparency. Increasingly, the technology allows us as traders, as humans, to use all kinds of tools that either inform our decisions or even make our decisions. And also they enable exchanges to make the trading protocol more sophisticated in some sense. And I worry about this new world and where we're headed if we don't put some checks and balances on where we're going. Because I like the core infrastructure, the core financial infrastructure, to be simple. I prefer it to be simple, and maybe a plain vanilla limit order book, just as an example for capital markets, is doing quite well, and everybody understands the way it's work. You get to send in, a buy order of a certain number of securities for a maximum amount of money, or a sell order for another amount of securities, and you want to have minimum price for that. And those are matched in a matching engine, and everybody understands that, and that can be run quite efficiently. Now, I don't want to disallow AI or all kind of algorithms, machine learning algorithms, to interact with that market. So I allow any participant to develop their own AI tools, and they can be so sophisticated that it's hard for humans even to understand what's being done. But as long as they make money, they'll be running, interacting with the limit order book. But then any promises, any trades that get out of this participant need to be collateralized. And a CCP is a working mechanism by which you can collateralize your promises essentially until, in the case of plain vanilla equity market, until the equity changes for the money a few hours later, maybe a few days later. And the moment that you accumulate losses, or your AI accumulates losses in excess of what you have put on as collateral, the limit order book or the exchange will stop you as a market participants until you recollateralize. So that way we protect people interacting with AI. So that is sort of a vision for the future that I think is a reasonable outcome for a market with increasing technology.
So then when we talked before, I will expand. So in my opinion, capital markets will do a lot more. There will be a lot more collateralizable assets in these future markets. Why do I believe that? Because when you think about the representation of assets that then can be traded and collateralized, that representation of assets becomes easier with tokenization, right? So, however, tokenization is not a new invention, right? Most of our assets, most of the financial assets already exist in some form of digital entry on a ledger, which you could equate to a token, really. But what I like to think about, to expand the universe of collateralizable assets, you should think in balance sheet terms. And when you think about the technology allowing for the representation of some of the items and the assets that live on balance sheets, there will be a lot more assets represented with tokens, cryptographically secured. And of course, when you think about what lives on balance sheets, we have financial assets, intangible assets, and tangible assets. And many of those will be represented in the future quite securely and quite well understandable with tokens. So these tokens then will start to live in tradable environments, capital market environments. So it's an exciting time because we will expand with technology and certainly with this unique invention of an immutable ledger, cryptographically secured ownership, so to speak. We will expand the universe of collateralizable assets in capital markets. And now Alexei will tell us, how he thinks there is good news and there is bad news to this world, to this future world.
Yeah, sure, thank you. First of all, to follow up on Albert's point, I unfortunately don't sleep well at night. I guess it's a difference between academics and practitioners. So that's just life. And that's why optimistic and pessimistic scenarios are important. Before I go into this, I'll just take maybe a couple of minutes. The session is obviously future of capital markets, and we talk about, even if you look at this conference, people either talk about AI or they talk about blockchain, right? And to me, if you think about those two things, in the context of capital markets, blockchain or tokenization more specifically is a market structure. This is what is changing in market structure. And as Ralf said, we already have tokens. We just have probably inferior tokens, and we can make better tokens. And AI is arguably a replacement for a human component. So we had programmers designing tools to trade better and limit order books for the last 20 years. And now we have AI basically replacing some of this stuff. To be honest, in limit order book, all the deep learning was used for about 10 years and has been quite successful already. To me, the simple analogy is a driver and a car, right? Market structure is a car and a human is a driver. There's no point of having a better driver if you still have an old car, and there's no point of having a better kind of car if the driver is still the same, right? So it has to go into kind of, if you change a market completely, right, you have to go step and step. And to me, because we're futurists here, effectively we're talking about the future and nobody really knows, right? But the optimistic scenario is obviously all your tokens. We tokenize everything. If I go to my PhD program, we talked about complete markets. So we make the market fully complete. We can bet on every single outcome. We have tokens for everything. And we have AI agents which effectively execute and make sure the information is propagated efficiently and aggregated efficiently, and this is done in a nice way. So this is like your optimistic scenario. Is basically like for people who watch movies, it's like a Star Trek, everything is great, the system is operating greatly. But there are obviously flip sides. If you remember, I'll check if I remember, I'm old enough to remember .com and all these kind of things, and things went well and things didn't went well, and certain things kind of added to the kind of inequality in the world, and other things giving better outcome for everybody. Or are we going to have a beautiful new world where like it's going to be, the power will be concentrated with a few agents, like say, let's say big hedge funds who have a fantastic tools, they make even more money. And the rest of the people are kind of just looking into this beautiful new world and they're looking at it, but they're not part of it, right? So that could also be, that's your bad scenario. Which scenario will play out is I guess it's up to us. We just have to manage risks and figure out what our objectives are. And different agents different human agents will drive different objectives.
So Alexei, may I? I like your point about completing the markets where more and more states of the world can be tokenized. But these type of and I have these discussions with my colleagues who teach asset pricing. They typically assume there's no frictions in markets, and you can keep introducing securities and trading. You can do at any time at zero cost. The moment you introduce frictions, that there's some search cost of finding the other party to sell your token to, it might not be optimal to have infinitely many or close to infinitely many tokens, because we're basically scattering the field with tons of securities, and if you want to trade it, there's nobody there. How do you think about these things?
Exactly. I think the friction costs are going to be reduced by AI, right? That's my hope. The old humans are not going to reduce the friction costs, because we all, as a former like PhD students many years ago, they always friction and search models, and arguably some of them are not relevant anymore because you don't have to search. The search costs are becoming smaller and smaller, and if you have your agent in a futuristic scenario, the friction costs are becoming smaller and smaller. But I absolutely agree with you. For me, I'm like too old probably to operate in the market which has so many outcomes, or too imperfect in a sense, right? I cannot track more than, what's the magic number, 7 things? In my mind, I cannot have more than 7 things. The rest just disappears.
But I think the technology will solve one key problem, which is, it reduces the cost of trust dramatically, right? So that's this genius invention of this immutable shared ledger blockchain, with Bitcoin as the first implementation. Whether it has any value or not, that is, of course, in the eye of the beholder. But it introduces a technological aspect which is completely new in an economic system, right? It is a cryptographically secured ownership, a bearer instrument that has an extremely high level of trust, which is introduced at very little cost. I mean, it needs the internet to operate, right?
Little cost, but to mine Bitcoins, we use electricity, right?
Yeah, but the electricity is widely available. I mean, it's unused, most of it, right? I mean, hydropower dams run all the time, and the electricity is not used. So that, of course, you're talking to a Bitcoin guy, but that's a non-argument in my opinion, right? So electricity is widely available. I mean, it's there. But so this wonderful invention of this, it reduces the cost of trust, and more technology will reduce the cost of trust, which means that economic activity can dramatically increase, because we stop spending money on people that create trust, like accountants, etc. It will also increase economic activity dramatically in environments where there is low trust, right? Where cost of trust is very high, badly functioning governments, etc. Right? Suddenly you have this technology where you can introduce trust at zero cost.
So what in your view is happening to information asymmetry? That can these AIs also resolve information asymmetry? I mean, if you talk about search costs going down, the search costs are part of the search cost is, one could say, is information asymmetry. Maybe you don't want to trade on the other side of products where your counterparty is better informed than you are. Will these frictions also disappear? I doubt it.
You're probably right. Certain information asymmetry is just structural to the market. It will be very difficult to reduce it. However, we can create big data sets which probably are more difficult to go through by a human, because you have to do it every day. With a certain amount of automation and AI, your classical information asymmetry where you don't want to trade, as a market maker, don't want to trade with people who are more informed than you. This is only working in the market which is not limit order book, where you know beforehand who your counterparty is. We actually deal, like my company, for example, we deal a lot with this stuff. we obviously don't have AI agents yet, but we have AI which kind of identifies people who are potentially not good counterparties to you. So we're kind of working towards this direction. I don't claim we reduce information asymmetry completely. I don't think it's possible. And maybe if it does reduce, if we do reduce it completely, there's no room for trading in the first place. If we all agree on everything, what's the point?
No,
right?
insurance. There's insurance reasons for trading, right? So,
yeah. But maybe we should take a step back and ask ourselves, what is this all good for? Right. So it's great we are discussing, deploying capital for the people that have capital. But let's talk about what finance really was invented for. Finance was invented to, finance or to enable economic activity, right? With uncertain outcomes, and we need to spread the risk among many participants. So then, how can we solve some of the more pressing problems? And the question here would be, so my passion is, of course, I think we have a working capital financing crisis still, right? Still, globally, we have a working capital financing crisis. Small companies, street vendors in emerging economies that employ families, that feed families, that have employees, cannot get financing efficiently, and it hasn't gotten better. So none of the technology that has been deployed has, there was a limited impact in these environments, right? You have some state-sponsored infrastructure like WeChat and Alipay and things like this that enable such economic transaction, but the financing part is quite frankly not well solved. So then how can we design systems, and think about how can we solve this persistent problem of working capital financing? Or maybe that's not the purpose. Maybe the purpose is to enable equity ownership for the globe, through applications that trade tokenized equities. I don't know. I'm asking both of you whether you have an opinion about that.
I think that this, to me, the first sort of friction for these small and medium-sized companies and their financing is, again, information asymmetry. Like, how do you know what you're investing in for these firms that might not report as much, that might be growth in nature? What's the type of growth? What's the competition? And, again, the good scenario would be that AI is going to help you collect data and make a first assessment. And that would reduce information asymmetry and hopefully create more funding for it. Because I agree with you, that's where the dynamic of an economy is in the small and medium-sized companies. They need to experience minimal frictions in the financing, and maybe through that channel they'll be able to raise finance at lower cost.
Yeah, with, for example, near real-time securitization on extremely short durations, right, which would allow people to take risk that normally they wouldn't take, in a balanced way, and also have risk-return profiles, in a much more near real time. You're doing that with capital allocation in highly liquid trading environments, right?
We do that, but I also have an example which goes back probably about 10 years, because I was looking at that quite actively back in that day. There used to be very popular things which now largely forgotten, peer-to-peer financing, right? Remember those platforms like 2015, 2016, 2017? What happened to them, and this is also an example of information asymmetry, or more informed agents or more powerful agents. Effectively, hedge funds bought the entire allocations because it's actually extremely attractive to finance certain type of people, especially if you do that. And on the risk-reward profile, especially in the environment of zero interest rates, this was an unbeatable proposition. And you as an individual willing to finance another individual is basically priced out. You're not part of that anymore. This was quite interesting outcome. So it probably related to your point about CME as well. But actually, I think on a grand scheme of things, it's a fantastic opportunity to finance CME. It's just like if you can spread it across the universe, and if you have some data, that would be amazing thing for me, say, like I have some spare capital. If I could allocate it to some CMEs in let's say, I don't know, some high growth countries, like I would love to do that, but there's no infrastructure to do this. I would even accept that I have some information asymmetry. I may not know something, but that's actually quite an interesting proposition.
We are already well advanced. Let's have some questions. I cannot. Oh, there are questions. Okay, we'll read it for the. What about liquidity dry-ups? Will AI agents solve or exacerbate them? In other words, what does it say? In other words, are AI agents more or less prone to
herding?
Herding than humans. Herding. Okay. Herding effects.
I think this is a wonderful, point that increasingly. So if you just from a distance replace humans acting on their information in floor markets by these bots trading on supplied information by direct feeds to exchanges, etc., interacting in an electronic limit order book, one could say maybe those information sets that the bots are trading on are more alike, and therefore we might have these AIs agreeing to trade in a certain direction because they're all feeding on the same information set, and that is a worrying scenario for me. So maybe there's an opportunity for humans, so smart humans, to take the other side in those cases and beat them. But I do agree with liquidity dry-ups of the nature characterized by the question.
I want to add, I absolutely agree with this also. This is probably one of the few academic papers I still read, but there were like a couple of fantastic academic/practitioner papers which looking at effectively how algos can collude and optimize effectively the outcome, which is not optimal for the principal, but optimal for an agent. And they even collude in the environment where, where you would expect them. They don't talk to each other. They just collude by observing the market and effectively moving in the same direction. They effectively do what a regulator will say it's a price manipulation. And a lot of people say, okay, if that happens, who is actually going to prison, by the way, right? It's not the program. Right?
So a limited set of underlying data leads to like AIs in a cult. They're in a cult. They have no other way, maybe. Okay, other questions? Not yet. Well, then, no, there are no more questions. So then, okay, let's maybe.
Can I make?
Go ahead. Yeah, go ahead,
because,
Albert. Yeah.
You were talking about let's take a plain vanilla equity,
yes,
and it's a digital asset, so it's in some sense it's a token. But I have a history of being a spokesman for a company in the Netherlands, the airline company, actually, KLM Oil Dutch Airlines. And I appreciated that we had ways of figuring out where our equity was so that we could communicate with our shareholders. In a world where you have tokenized these equities and you further distribute it in a larger population, it's much harder for companies to connect with their end users, because where's the end user? Does the end user even know that he has voting rights or is he entitled to a dividend? I mean, all these things we have to think through carefully in terms of the communication between a corporate and their financiers, the equity holders. That's an important point for me.
Yes. With AI democratizing sophisticated trading strategies and retail investors now wielding institutional grade tools, yeah. How do you see the traditional hierarchy between institutional and retail capital markets collapsing? And what's your play to either accelerate that disruption or position yourself as the essential infrastructure when the dust settles?
Maybe that's a good question for you, Alexei. Data infrastructure.
Thank you. Yeah, I think it's interesting actually, because I would say it's on one hand it's illusion of institutional grade tools, because institutional grade tools, what you mean by that is that you can easily connect to your Interactive Brokers account and you can run, AWS based kind of robot or bot or whatever, which kind of trades. And if you're a good programmer, you can have an illusion of kind of trading, and some people make money, right? And there was an excellent presentation by my friend Vikas, like about 2 sessions, two days ago, about retail options in India, where all the retail people lose money quite a lot, right? It was shown by him, but also by working a lot with retail brokers. And I'm not particularly kind of I wouldn't be saying anything which is particularly controversial. We have this 390s rule, is that 90% of people lose 90% of their money in 90 days, and that's pretty well-known thing. It's not like anything new. So what I'm saying here is that it's an illusion, unfortunately, in my opinion, and that's something that goes back to my scenario thing. I think just because you can connect to an exchange and you can trade doesn't mean you're going to be like on the same setting as proper kind of people. But on the other hand, if you have ability to play your cards reasonably well and your advantage, maybe it will be fine. That's
so maybe then we can maybe Albert, you're sitting with regulators regularly. You're advising some capital markets infrastructure people which are either regulators themselves or close to regulators. How do you think about the risk then? Now that suddenly we live in this world, in this meme world.
So for me, and this is related to that question that's asked, like the AI democratizing access to capital markets. That is a very romantic vision of AI. It might actually be that AI is used to, and there's a wonderful, I forget the name of the center, a foundation that thinks through, trying to control the way machines change our societies. And part of their manifesto is they warn for AI persuasion, that these companies are so good that they know where your buttons are, and they're able to touch your buttons and make you believe that I'm going to be doing something good for you, and when I advise you to do this, that, or the other. And so you can use AIs to control a population, and you want to take them, you want to maybe control them in a way that they're going to take the other side of a very profitable bet for you. So I'm not agreeing with AI democratizing or creating equal access for everyone in the marketplace.
So that's like the Wolf of Wall Street in AI agents, right? So when you think about the boiler room. Yeah. So any questions for the audience? I have one more point. Maybe
Ralf, can I ask you something?
Yeah,
because
please.
I watched your video recently that you gave at the key. What was it? The Eurofinance
Eurofinance,
yeah. And the title of your keynote was "We're Headed for Disaster: Tokenizing Assets." So maybe you can tell us why you're so worried.
Sure. So I see 2 risks actually, which I didn't touch upon in this video. So I really believe that this obsession about tokenizing everything is great, because as I said, it will increase the universe of collateralizable assets. But when you talk about financial assets, financial assets are typically backed by promises for future payments. So that's what I buy when I buy a bond. That's what I buy when I buy a mortgage-backed security. Now, if I do not understand what is inside this token, which means what the token represents in terms of cash flow streams into the future, then I have a hard time really, making any decisions about it. And if I just take, an asset manager's word for it that everything is good and it's all okay, that these payments will come in the future, that's a problem, right? So that's what I say. Currently, the industry is tokenizing really badly. Currently, the industry is issuing a token and putting a PDF or a hash of the term sheet or the prospectus in the token and claims that this is now a bond. And then we sell fractions of this token to other people, and that's tokenizing, right? And this will not work, because we've proven in the financial crisis and many times before that unless you have an understanding of what is inside and you understand the state of each individual obligation inside an asset-backed security, you really have nothing. And currently we have nothing, right? They are only producing dumb tokens, if I use the polite word, and stupid tokens, if I use the word so people remember me when I speak on stage. And this is the biggest threat to the financial system. So now when you think about Larry Fink, who's betting on tokenization, he's betting on tokenization backed by Aladdin, which is the information system that is inside BlackRock. And we are here now in Northern Europe. You may know that in certain parts of Europe and other capital markets, there's really no other asset manager left than just a few companies. So they basically tell us, you should believe me when I give you a net asset value of a certain instrument, right? And if we perpetuate, which they can, we take them by their word, but most of the time they just do it in an Excel spreadsheet that was constructed 15 years ago, and it may or may not be accurate. So now if we transpose these problems on tokenized, on DLT and on blockchain, we will basically recreate the current problems of the legacy financial world. So that's one problem. The second problem that I don't touch on in this video is in this presentation, which I just thought about recently, is there needs to be a discount or a premium for certain infrastructures. So now in SWIFT or in other settlement infrastructures or DTCC or CCPs, we can be certain that the counterparties that participate make us whole if there is a problem. Now in blockchains, that's not the case. You cannot be certain to be made whole because you do not control the infrastructure that this value is traveling on, right? You cannot be, this is a big threat, right? So then we have two problems. First, we don't know what it is that we're really putting on these rails. And secondly, I have no control over the rail. I can assume that Ethereum is very trustworthy. I can assume that many other layer ones are trustworthy and function because we can observe them, right? And it's open source. But can I be made whole? Is the asset really there when I need it? If there's a mistake in the code, can I really recover it? I can recover it from a CCP or from a custodian, but I cannot recover it in a DLT-based environment. So I think risk premiums are not properly assessed. That, by the way, is also true for stablecoins, right? So we have to think about there should be discounts to stablecoins because they're not running on traditional infrastructure that is as reliable. They're not running on infrastructure that is as reliable as the current infrastructure. Some people argue it's more reliable, but it's only, some of this stuff has only been in operation for 5 years or 7 years or 10 years. Is that enough to not warrant a premium or a discount? So thank you for bringing that up. I think that's a big problem, right? And regulators do not understand. There are some market participants that do understand because these business models do not take off, right? So we've been talking about tokenization at least since 2016, on these DLTs, right? And these business models do not take off, right? Lots of VCs have spent a lot of money and it just doesn't advance. And my theory is, and my hypothesis is, it doesn't take off because they're not adding more value to the value chain in capital markets because they're missing this piece of the algorithmically defined payment obligation inside these instruments. So that is a big risk. And then imagine you have AI agents starting to move around these tokens that are ill-defined to begin with, right? So this is and you could argue that equity shares are also ill-defined because it's just, well, they have a price and so on, right? But what makes an equity price? What is the difference between price and value? You really need to understand these things. And thanks to machines, we can understand the difference between price and value in the future in a fairly reasonable way because of certain innovations in technology.
Yeah, I would map your point, to which I much agree. Like, what's inside the coin? Some people know, some people don't. That, to me, is again classic information asymmetry friction that we know a lot about in finance.
Oh, maybe I should package it in information asymmetry.
Yeah.
Which, right? So, and then of course, in terms of market structure, what now these tokenization projects recreate is. They're trying to solve this information asymmetry with new startups, right? And quite frankly, that's not going to create a more efficient system, right? Mike Bloomberg is one of the richest men in the world because especially he's monopolizing some of this information, right? And earning economic rent. So if we want to have a more efficient system, we cannot just have other intermediaries, reduce that information asymmetry and also earning, outsized economic rent, if you want to stick to economic speech.
So essentially, the problem is imperfect old world is holding the beautiful new world from taking off, right? But can AI solve that? Like the kind of composition of these MBS kind of thing?
Yeah, so AI has a big... I believe that AI in financial environments will only be successful if you have a clear distinction between probabilistic problem spaces and deterministic problem spaces. And the financial system itself is a deterministic state machine, right? It's a state machine, but it operates on deterministic basics, right? Which is why we are advocating for the ACTA standard, which defines, granularly the payment obligations in algorithmic form. So AI can solve that, but AI needs to understand deterministic financial contracts and how these deterministic financial contracts are influenced by probabilistic stochastic problems that just exist in the world, right? But in the end, if agents cannot compute, they cannot negotiate financial contracts, they will not be able to verify financial contracts, they will not be able to risk manage financial contracts, etc. So that's a precondition, right? So it'd be helpful if regulators would also recognize that and basically try to enforce a simple underlying system and not listen to their investment banker friends who are, throwing a lot of smoke grenades, right?
I see a red 0.00 flashing here.
So no more financial. But we are the last ones before lunch.
There is a utopia versus dystopia final point.
Okay, final point. What is the utopia? What is the ultimate good scenario? What is the ultimate bad scenario?
Well, ultimate good scenario is clearly, complete meritocracy. Everybody gets, what they deserve, and AI agents just basically allocate capital, and humans just kind of consume. Okay. The dystopia is completely opposite. We have a bunch of things, and we effectively think about, people old enough remember Matrix or some movies like that, or Elysium. Elysium comes to mind, right? Where this elite lives in a planet somewhere, and we're all here basically kind of looking at this thing in a telescope and saying life is beautiful there, but we cannot get there.
Okay, I'll go before Albert. I'll leave Albert the final note. So I think utopia for me is that any firm can get working capital highly efficiently, down to almost the ones that bear the ones that fail. Anyone above failing should be able to finance working capital. That would be for me utopia.
My final word is I very much enjoy this panel. Thanks so much.
Thank you.